Are we currently in a real estate bubble? It's one of the most searched questions on the internet at the moment. And in today's video, we're going to take a little bit of time and explain the topic of a real estate bubble. We're going to go back to the last time, 2007, when we had a housing crash, a housing crisis, if you will, because that's the time that everyone wants to compare us to. They want to take 2007 and compare us to 2020, 2021, because home prices are rising. People are bidding over, the last guy. We're reaching new highs with regards to, record set with home prices in a lot of markets out there. And it's, there's just this craziness. There's a lot of fear on the sidelines. People not sure what to expect because of potential inflation coming down the road. You've got a lot of stimulus floating around the economy. But at the same time, you have people that took mortgage forbearance, that have still not come out of it. I think there's nearly 2 million people that are still in mortgage forbearance. And at the same time, you have foreclosures being put on hold along with evictions. And so there's this fear out there. Everybody wants to say, well, it's exactly what happened in 2007, and we're going to see a repeat of that crash. And in today's video, we're going to explain the differences in the two. We're going to start with 2007, but we're going to go back and forth. We're going to talk about then versus now to help you, understand the differences in the two. Maybe you know exactly what happened because you were in the market at the time. But I'm going to take some time and break it down for you in a little bit more detail. We're going to talk about, prices back then versus now, payments back then versus now, and just help you understand exactly what it means if you're out there in the market. Now, the goal here isn't to get you to buy a house or to sell a house, but it is to provide you with information so that you can make rational, informed decisions if you are in the real estate market. And it doesn't matter if you're on the selling side or the buying side. The more information you have, the better guidance you have, the better you will be at making the right decisions, rational ones versus emotional decisions. And so that's what the goal here is. And we're going to start today by talking about 2007. 2007 was a market that had price increases very similar to what we're seeing right now, right? Prices were rising at such a rapid pace. There were multiple offers on a lot of property at that time. And, it was just this frenzy, right? Very, very similar to what we're having right now. So the craziness in the markets was similar. And I think that's what a lot of people want to relate it to. But there's some fundamentals of 2007 and 2020, 2021 that are completely different. And the first one is going to be lending standards. What do I mean by that? Well, in 2007, it was very easy to get a loan. In fact, the verification of income, verification of employment, verification of down payment didn't really exist in a lot of ways. It was, you could go in to your local bank, to a local mortgage broker, fill out an application, put that you made whatever you wanted as far as income goes. And a lot of that information wasn't verified. They were called liar loans, right? Because you could literally lie on the application and get a property. And because of the types of loans that were going around at that time, adjustable rate mortgages, negative amortization type mortgages, it allowed the payment to be a lot lower than what it should be. And so people were going out buying properties way more than they could afford because it allowed a lower monthly payment because of these adjustable rate mortgages. In fact, 45% of first-time home buyers back in 2007 had no down payment. 100% financing on their mortgage at that time. So 45% of first-time home buyers at that time had no down payment on their mortgage. And so they bought a property, 100% financing, and they used adjustable rate mortgages at that time in a lot of ways, and sometimes negative amortization loans. And what is that? That is a loan where you're not even paying the interest on the loan. So every single month you make a payment, that your loan balance actually goes up versus comparing it to a 30-year fixed of today. Whatever you make your monthly payment, your balance is actually going down. And at that time, there were interest-only loans as well, which means you were paying the interest on the loan, but, the principal wasn't being paid. So your balance was staying the same. And in a market where things are appreciating, maybe not necessarily a big deal. But at that time, what you had is you had a stall in the housing market, right? Prices stopped going up. People's balances were the same as when they got the loan a couple years earlier. In some cases, the balance was higher than their loan a couple of years ago because they weren't paying all of the interest on the loan. And, what happened is prices started to come down, right? So homes were significantly less, and, people owed more on the homes than they were worth. That's problem one. Problem two is that they got into adjustable rate mortgages, these negative amortization loans where, they were only fixed for a very small, percentage of the loan, 2, 3, 5 years in some cases. And what happened is as those loans started to adjust, right? So they reached the end of that fixed period, in some cases the end of that interest only period, and now the loan started to go to a fully amortizing payment. Their payments jumped significantly. And so these people who lied about their income, lied to get into the loans, could no longer afford the payments. And they weren't in a position to sell their property because now they owed more on it than it was worth. And so, and it was just this mess, right? And so people decided, what? I don't have an option here. I'm just going to foreclose on my property. And so, foreclosures become prevalent, short sales became prevalent. And so you started having all of this supply come to the market. At that time, nearly 10 and a half months supply of homes on the market during 2007. And so people were unloading their properties. Competition was fierce out there with regards to selling. Buying had dried up because lending standards became very, very difficult. Less people could qualify for a loan at that time. And it just became this whirlwind, if you will, with regards to real estate. And we're not even going to talk about the downfall of the mortgage industry as a whole. We're just talking about real estate in general. So at that same time, interest rates were around 6% in some cases, right? So on a $350,000 home at that time, a 6%, loan, and chances are this was an adjustable rate in many cases, your payment was just under $2,100 a month, $2,098 or so. So your payment on that was $2,098, but if you did an interest-only loan, your payment dropped down to $1,750. Okay, now keep that number in mind because we're going to compare it to where interest rates are today and what that same payment would be. Now, let's talk about our current market, right? So everybody wants to compare the two, so we're going to do that. Lending standards in today's market, very, very strict. It's difficult to get a loan. If anybody out there has been through the process, what a pain it is to go through that process. The documentation of your bank statements, the assets, your employment, then re-verifying your employment, all of these nuances that are a pain to get a loan, but should have been required back in 2007, and they weren't. So lending standards are much, much higher today. Most buyers getting loans today are getting 30-year fixed loans versus back in 2007, most of the loans were adjustable rate. What that means is you've got a fixed payment, right? You got a fixed asset for one, a house. You also have a fixed payment on that asset. So that means if you are worried about inflation, if you are worried about the cost of goods, services going up, rents, if you will, because a lot of people out there are expecting rents to continue increasing with this inflation talk, that means your monthly payment on your rent is actually going to continue to go up year over year. Whereas if you have a fixed mortgage, your payment is fixed. It's not going to change. So if you've budgeted properly, it's going to be something that you can continue to pay. So you've got 30-year fixed loans right now. And, we talked earlier about, 45% of first-time home buyers back in 2007 had no down payment on their loan. That's compared to just 17% today. So 17% of buyers still have no down payment on their loan. And these would either be like USDA loans or VA buyers putting no money down. So significantly less people putting no money down than back in the day. You have the greater majority of people doing 30-year fixed loans versus adjustable rate loans. Now, we talked about supply, right? Back in 2007, you had over 10 and a half months of supply, nearly 11 months of supply. In our current market, we have around 2 months supply of homes. How does that compare? Well, back in 2007, you had nearly 4 million homes on the market. Okay. Existing homes, 4 million homes on the market versus today, 1.16 million available properties on the market. So you have a quarter of what you did back then. Significantly lower inventory, 2 months supply in most markets. So you have a lot less inventory out there. And another thing you have is larger down payments. Right now, the average home buyer is putting 15.9% down when buying a home. So significantly higher down payments than you had back in 2007. And another thing you have is equity, right? Home buyers have equity now versus in 2007, there was no equity in the market, right? Property values had decreased, and adjustable rates were turning over. Right now, you have homes continuing to increase in value. So anybody that purchased a home a year ago has, 10, 11, 12% equity gained in their property, depending on the market, year over year, plus whatever their down payment was, plus however much they've paid down on their mortgage. So you've got significant amount of equity. In fact, we've got more equity in the market now than we've ever had. So you've got, again, a fixed payment on a fixed asset with more equity than you've ever had. Now let's talk about that $350,000 loan that we talked about earlier. Back in 2007, that $350,000 loan at 6% was nearly $2,100 a month, $1,750 on an interest only payment. Whereas today, that same $350,000 loan at a 3% average interest rate is just $1,475 a month. So it's significantly less than it was back then. In fact, you could buy a $500,000 property today for basically a payment that would have cost you on a $350,000 home back in 2007. So, wages have increased since 2007. And yes, property values have increased, but because of interest rates going lower, you can afford more homes. So yes, homes are reaching record highs in a lot of markets, but the payments are still less than they were back in 2007. And so what I'm getting at here is that you're not in a bubble, right? This is a very, very strong housing market due to low supply, high buyer demand, driven by low interest rates. And this wasn't created because of the pandemic. We had a strong housing market back in February of 2020 prior to the pandemic coming to the market in general. But low interest rates, the Fed lowering the interest rates during that time and putting halts on foreclosures or what have you, restricted supply, which did add to this frenzy. But keep in mind, foreclosure starts back in February of 2020 prior to the pandemic were at a 15-year low. So even then, foreclosures weren't an issue. But, there will be some foreclosures as a result of this. Most recent numbers from Lawrence Yun, the National Association of Realtors, and we're nearly 6 million homes behind with regards to inventory. So it's going to take a long time for the housing market to catch up with regards to, new construction, forbearance ending, foreclosures ending, or what have you. So, this is not a bubble, people. You're going to continue to see a strong housing market. Now, again, as I've mentioned, this isn't to get you out there to buy a house. It's so that you have the information necessary to make the right decisions if you do decide to buy a house. But, I'm here. Would love to know your thoughts on the housing market. What are you seeing in your market? Yeah, you're probably seeing supply increase a little bit, maybe demand drop a little bit, but does that mean a crash is coming? My thoughts are no. I think as you see, more supply coming, I think demand is going to stay there. There's a lot of people that, that have these missed opportunities, if you will, on properties that they weren't able to get. So I think as you see home prices pull back maybe a little bit, these people that missed out on the market are going to get in, which is going to kind of, keep this thing moving along. But I'll continue to update you as I get more information on the housing market. If you have questions for me, comments for me, do me a favor, leave them below. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.